Thank you, and thank you very much. So pin the question for them. Ladies and gentlemen, I'm waiting to get a few answers from you for Mwalimu to continue. Is there somebody who has been able to get the labor rate variance? Labor rate variance, labor rate variance, labor rate variance. Is there somebody who has been able to get labor rate variance? Our first class where we were doing variances, So then that means that I need to start afresh with material price variance. I have to do this, material price variance. So right there, material cost variances. So material cost variances, we have two of them. We have the material price variance. And then number two, we have the material usage variance. So material price variance and the material usage variance. This is the one that we abbreviate as MPV, material price variation. And this is the one we abbreviate as MUV, And remember, word of caution, this is a topic for CPA section 2. 83 students can't, or rather they don't have this in their syllabus. They don't have these in their syllabus. They don't have these in their syllabus. So unless you simply stay there for purpose of getting just a broad understanding of the subject, but you can't be examined anything from this area. So we have material price variance. How do we get material price variation? Variation means difference. Difference between two prices, material price variation. Material price variations. So we have the price that we thought we would have incurred ourselves to purchase a kg at. And then, of course, we have what we call the actual price. We have the actual price. So we have standard price vis-a-vis what is somebody, actual price. Actual price. And then, of course, this will be a variation for only 1 kilogram. And I want the totality of it. So for purpose of getting the whole variance, I need outside here to come and multiply this with the actual quantity of materials that were purchased. So for the sake of the students who have never been with us while doing this particular topic here, I would want them to write there that this SP stands for the standard price per kilogram. So if you look at the question that is pinned there, ladies and gentlemen, you will be able to see from the standard cost card of producing a widget up there. Immediately after the first paragraph, we are told that the company operates a standard costing system and analysis of variances is made every month. And then they have given us the standard cost card for the product, which is a widget. So we have the standard cost card. They can see from there, from the pinned question, we have the standard cost card. From the pinned question, the standard cost card is giving us direct materials, 0.5 kilograms, 0.5 kilograms at $4 per kilo. At $4 per kilogram. And then right away here, they're giving us dollars how many? $2. Now, ladies and gentlemen, please check out this with me. If you can see my board very well, we have direct materials. We have 0.5 what here, somebody? Kilograms. 0.5 kilograms in the standard cost card. And each kilogram is going for 4. So that a whole unit, which requires 0.5 kilograms, each kilogram going for 4, each unit will be costing us 2. But remember here we are talking of standard price per kg. So the standard price per kg here is 4. So then go to straight away the actual information and pick for us. This AP is actual price. AP is actual price per kilogram. Actual price per kilogram. If you look at the pinned question, go to the actual information. If you go to the actual information, the information which is given after the standard cost card table, they are telling us budgeted output for January was 5,100 units. And then we have the actual results for January were as follows. So we have the actual results there. In this actual results, they have given us the actual production. If you're able to see your question very well there, they have told us the actual production was 4850 units. And ladies and gentlemen, they have given us the materials consumed. They have given us the materials consumed, which amounted to 2,300 kilograms. 2,300 kilograms at a total cost of $9,800. So I would want to get the actual price of materials per kilogram from the actual results. So in this case here, the actual materials per kilogram, you can see the total cost is 9,800 for producing, or rather for procuring 2,300 kgs. Therefore, the actual price per kilogram will be 9,800 divided by 2,300. We don't like getting the decimal. So please come and substitute now the figures that we have here. I can see the standard price. The standard price here is 4 minus the actual price which is 9,800 divided by 2,300 multiplied by the actual quantity that was purchased. We know that we purchased and consumed 2,300 kilograms. So please come and give us on the other side the equal what? What is material price variance? You say 4 minus 9,800 divided by 2,300 equals whatever you get there times 2300. Or you open bracket, say 4 minus this, divided by that, close, times 2300. What figure are they getting? No. It's because she rounded off. It's because she had put this figure separately. We don't want rounding off errors because our operating statement will not reconcile. The very best, just put these figures like this, So say open brackets 4 minus this divided by that, close, times 2300, give us a figure.
600.
600 adverse. It is 600 adverse. Adverse because of negative. The variance itself is negative. The variance is negative, meaning bad performance on our side. So the material price variance is 600 adverse. 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 Now, from there, ladies and gentlemen, straight away go to the material usage variance. Remember, we are saying it's adverse because when you divided this, you must have gotten a figure which is more than 4, meaning that we actually ended up purchasing these materials at a higher price, at a higher price, at a higher price. So in this case here, material usage variance will be equal to formula. We have the standard quantity minus the actual quantity. And then outside here, we have what we call the standard price. So usage is all about quantity. Kama ugali, unasema leo ugali, sababu tuko wageni wengi, tatumia exactly 2 kgs. Piku ugali watu wote. Lakini unapoenda kupika, there is a possibility that you could use either more or what here, less. So we have our standard quantity, and then we have our actual quantity. Please don't forget that this capital SQ is standard quantity for actual what here? For actual production. It is standard quantity for actual production. And then allow us to write here this in full. This is standard quantity of materials for actual production. For actual production. Meaning that, ladies and gentlemen, you must involve the number of units here that were actually produced. The number of units that were actually produced here. The number of units that were actually produced here. So come to AQ. AQ, what does AQ stand for? This is actual quantity. This is actual quantity, ladies and gentlemen, of materials. And the actual quantity of materials, you're the ones who gave me from this actual result. Who told me that we actually purchased and consumed 2,300 kilograms, the actual quantity of materials. Sorry, don't confuse with production. Actual quantity of materials is 2,300. 2,300. And then, of course, SP, this one is not lost on us. SP is standard price per kilogram. And you guys gave me a figure of what is the standard price per kilogram. You gave me a figure of 4. You gave me a figure of 4. So let's come back here. Standard quantity. Please go to your standard cost card. If you go to your standard cost card, you'll be able to see the standard quantity. What is our standard quantity, ladies and gentlemen? Our standard quantity is here. We can see our standard cost card of materials, direct materials. We have 0.5 kilograms. But remember that this standard quantity must always be multiplied with the actual production. The actual number of units here that were produced. The actual production here was 48. What here was 4850. The actual production was 48. The actual output, the actual number of units here we produced was 4850. Minus the actual quantity of raw materials. Actual quantity of raw materials that was used, which you guys gave me a figure of 2,300. Multiplied outside here with the standard price per kilogram. The standard price per kilogram is here. The standard price per kilogram is here. It is 4. The standard price per kilogram is 4. So then what you do, you get your calculator, you say open bracket, 0.5 times 4850 minus 2,300, close, times 4, please give us a figure. Times 4, please give us a figure.
500 F.
500 favorable. Favorable. So those are the material cost variances. Why are we calling this thing favorable? We are calling it favorable simply because we have gotten a positive variance. Positive variances impact on our profit positively. 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 So that is okay. That is okay. Now let us go to the labor. Labor. Let's go to the labor. Please, if you have questions, don't fear to ask them. If you're not able to understand your mwalimu and you feel that your mwalimu is letting you down, you tell this mzee, thumbs down like that. I'll be able to improve. Thumbs down, thumbs down. And of course, I want to believe that there are students who got these questions correctly. We got the labor. We got the labor cost variations or labor cost variances. There are two. Number one, we have the labor rate. We have the labor rate variance, labor rate variance. And then number two, we have what we call labor efficiency variance. Labor efficiency variance. So this is the labor rate variance. This is the labor efficiency variance. Labor rate variance versus labor efficiency variance. So we begin with labor rate variance. Labor rate variance. What I don't know is whether there is a student here who can write the formula of labor rate variance offhand without making reference to any literature. Not their notes, not textbooks. What is the labor rate variance? Somebody there. What is the labor rate variance? What is the labor rate variance? Labor rate variance.
SR minus AR.
Very good. It is the difference between two rates of paying workers. So we have these workers at the beginning of the year, ladies and gentlemen, as a college. We may have put a very high rate for them because we thought that this year would have been a good year. So we have in this case here standard rate. But when the year progressed, as the year progressed, ladies and gentlemen, boom, Corona hit us badly. So we had to sit down with our lecturers, negotiated with them. We told them, you can see the entire premises are what here, they are empty. What do we do? Instead of you going home with nothing totally, let's give you an actual rate which is even like 50% of what we had promised, of what we had started paying you from January, like that. So there are many situations that will make the standard rate and the actual rate to be different. So we have here standard rate minus actual rate. And then outside here, we have what we call the actual hours, in this case here that were paid. So we have this SR is the standard rate per hour. The standard rate per hour. This is the standard rate per hour. SR is the standard rate per hour. So I'm now working with the materials, rather with labor. So with labor, I would want to know two things: the standard labor cost and the actual labor cost. So please go to your standard cost card if that question could be pinned for you. If that question could be pinned for you. If that question is to be pinned for you. If that question is to be pinned for you, we have our standard cost card, where I can see direct wages. Where I can see direct wages, which is our direct labor cost. Our direct labor cost, ladies and gentlemen, we can see 2 hours, each at $2 per hour, giving us a total of 4 for every unit. And then go to the actual labor. The actual labor from the actual statement given down there, we can see the labor hours paid. Labor hours paid, ladies and gentlemen, labor hours paid were 8,500 hours, 8,500 hours at a total cost of $16,800, of $16,800. I love variances. Why do I love variances? I love variances because I know number one, it must be tested in your exam. And the people tend to fear it for nothing. Actually, it is the easiest topic. You can't even compare this with process costing. No, this is a very easy topic. Very easy topic. The only thing that you need to be doing is to know how to throw your eyes. When they talk of standard rate, you throw your eyes to the standard card, the standard cost card. So like now here, the standard rate per hour, the standard labor rate per hour here is $2 per hour. So I'll come and say this is two. This is $2 per hour. How about AR? AR stands for the actual rate per hour, the actual payment per hour. Ladies and gentlemen, I can see my labor indeed cost me 16,800, but with this 16,800, I procured 8,500 hours. So the actual rate per hour will be 16,800 divided by 8,500 like that. So the worst mistake that I can ever do in terms of variances, ladies and gentlemen, is to divide this and then I get mid. Not unless this figure will give me a beautiful decimal point. Because I know that this 16,800 is for this number of hours, but I want rate per hour. That's why I have to divide like that. So ladies and gentlemen, please come and substitute here and give us the labor rate variance. So the standard rate you have given me, 2, minus the actual rate you've given me, 16,800 divided by 8,500. And then we have AH paid standing for actual hours. Actual hours, ladies and gentlemen, the actual hours. Actual hours here were how many? The actual hours were 8,500. The actual hours that were paid were 8,500. 8,500. So please, in this case, you take a step of faith, take out your calculator, say on, open brackets, 2 minus this divided by that, close, times 8,500, please give us a figure. Times 8,500, please give us a figure. We put it down here. Give us a figure kindly. We put it down. Give us a figure kindly. 200. Favorable. And then what I would want you, my brother, to do a little bit is scroll the answers for them. It's good for them to know, especially for the students who have gotten this much earlier. It's good for them to see that they got the correct answers by themselves. That's how they get to feel proud. You scroll the answers slowly there for them there. Okay, so somebody give me the answer here for labor rate variance. You said it's 200, yeah? 200 adverse. So 200 adverse. Adverse, why? Because they got a negative rate variance. A negative rate variance means bad. But remember what we said in our earlier class. You can't say minus 200A. Once you talk of A will take care of what here, somebody? The negative. A will take care of the negative. Now, if you're able to follow, ladies and gentlemen, what I'm discussing, I want to know whether we are together by you guys saying yes, we are able to follow, just yes or no. If you're able to follow, if you have been able to follow up to exactly where we are, will you kindly respond there by saying yes or no if you haven't been able to follow?
You're asking, is it F or A?
Is it an F or A? Somebody. You know, I don't have a calculator myself. I don't have a calculator myself. The figure that you guys got here, is it positive or negative? Is it positive or negative? And thank you very much for opening up. Is the figure that we got here, difference here, is it positive, this figure? Is it positive or negative?
Most of them are given F.
It's F. If it's positive, then automatically it's favorable. Thank you and thank you very much. It's favorable. Now, ladies and gentlemen, you haven't yet answered my question. I simply want to know how we progressing. Are we together really? Are we together? Is there anything that you guys would want repeated? What are they saying there?
Yes.
Yes. Thank you very much. So that is the case, and I hope it is coming from the bottom part of your heart. I should not force you, no. Online classes, after all, you're not even near to each other. I'm so sure there could be somebody here who is in Mombasa attending our classroom in Nairobi. Yes. So you should not fear anything. You should not fear anything. So from there, in terms of labor, we go to labor efficiency variance. For those students that I taught you some time back, for you to be able to understand the efficiency variance, I told you the tribe in Kenya here that runs their businesses efficiently. If you're working for them, especially at the earlier years of your life, if you're working for those people, they will always ensure that you get the best experience. They are Indians. Indians are very efficient in terms of how they run their businesses. So we have labor efficiency variance. Labor efficiency variance, every time they talk about efficiency, I will remember my friend, Mr. Shah. Mr. Shah. Mr. Shah, like that. I will always remember my friend, Mr. Shah. Efficient. Why? Because some of their businesses are able to run for more than 200 years. Go to Kirinyaga River. Some of the oldest businesses you are seeing there belong to these Shahs. They have been able to bequeath them to their generations. But in Africa, like now, our brothers and sisters from our own tribes will start a business that does very well. But when you die with it. So you're not very efficient. So come outside here and put what here? The standard rate. Please, whenever you see capital SH and capital SQ, you must know that capital SH stands for, whatever has to be written in full, for actual production. For actual production. For actual production. Just like capital SQ, there are two themes that if you happen to understand very well, you can never go wrong in this subject. We have capital SQ and then we have capital SH. Capital SQ, standard quantity for actual production. Standard hours for actual production. So please go to your standard cost card. Standard cost card, you are able to see the standard hours. You are able to see the standard hours here are 2. But now remember, because of the word actual production, you must look for the number of units that were actually produced. And if you remember very well, actually we had this figure where we said that the actual production was to be 48 what year? Was to be 4850. So we have 2 times 4850, 2 times 4850 minus actual hours. Minus actual hours. Ladies and gentlemen, for actual hours, how many actual hours should I use? How many actual hours did these guys work? How many hours they actually work? How many actual hours did they put into the production? I'm waiting for your response. 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 I'm waiting for your response.
8,000 hours.
How many of them are saying 8,000?
Majority.
Majority. Thank you very much, ladies and gentlemen. Remember that these hours for efficiency, hours are supposed to be the hours worked, not hours paid, hours worked. Ladies and gentlemen, there is a place where they've told you the operating, my cameraman can see me all the way up to here, the operating hours. Operating hours are the actual hours worked. Actual hours worked. These are the actual hours worked. And you can see that they were how many? They were 8,000. To see how efficient these people were, we will always work with actual hours worked. They were not 8,500. 8,500 hours were the hours we actually worked, or rather we actually got paid for. But the actual number of hours worked were 8,000 only. Into outside here, we have the standard rate. Outside here, we have the standard rate per hour. Remember, capital SR is standard rate for every 1 hour. The standard rate per hour here is 2. The standard rate per hour is 2. The standard rate per hour is 2. So could you kindly give me an answer there?
$3,400.
3,000?
400.
3,400. So we have here 3,400 address. 3,400 address. 3,400 address. That is labor efficiency variance. Ladies and gentlemen, the last type of labor variance is called idle time. Idle time variance is called idle time variance. Idle time variance. Idle time variance. How do we get this labor idle time variance? To get the idle time variance, we normally take the standard rate given times the idle time. Standard rate times the idle time. So what is the standard rate? The standard rate given, ladies and gentlemen, the standard rate given, you guys gave me a standard rate per hour of 2 per hour. So this is 2 times how many hours are idle? How many hours will be considered yet to be idle? Those hours that we paid you to work for us minus the hours that you actually worked.
Should be favorable.
Should be?
Favorable.
This one should be favorable.
Yeah.
Are you the one who reads for me wrongly or what?
Let me see. Most of them might be.
Is anybody already given an advanced answer? Really?
Let me see.
Adam, the one who read for me wrongly. Please be reading the correct parameters.
The first one is giving advice.
It can't be advanced when it is positive, please. Please, when it is positive, it cannot be adverse. When it is positive, it will always be what here somebody favorable. When a variance is positive, it is always favorable. Leave alone those aspects of coming to compare. No. Just a positive answer is a favorable variance. Thank you very much for that correction. So then we have here 2 times idle time. Remember, we paid these people to work for us for 8,500 hours, but they only gave us 8,000 hours. So I can see some room there of idleness. So we have here 2 times the idle time is 500, which gives us 1,000 adverse. Remember, all idle variances, idle time variances are added. There's no employer who will be happy paying workers who are not working for him. All idle time variances are normally adverse, yes.
Which is one equal saying, but you say the efficient is an exception.
No. We haven't reached there. Remember, exceptional variances will normally start from fixed overheads. These are normal variances, material, labor. These are normal. They're not exceptional. Exceptional comes at fixed overheads and above. Fixed overheads. I hope I've answered your question. Okay, thank you very much. Thank you very much. So you have said idle time will be what here? Will be adverse always. Please ask as many questions as possible. The one we're saying that we say efficiency are exceptional. Please just look at your notes. I even never mentioned anywhere efficiency being exceptional. We say the exceptional variances are fixed overhead capacity, fixed overhead volume, and all sales by. Actually, efficiency is never exceptional. It's never exceptional.
Then
Now,
you see him saying repeat on how to get idle time.
idle time. Idle time, remember the actual hours we paid was 8,500. But they worked how many hours? They worked 8,000 hours. The difference is what here? 500. This is what we call the idle time. But now you have to measure this in terms of money. So in terms of money, this one here will be, we have the idle time variance. Idle time variance will be equal to standard rate times the idle time. So it will be standard rate per hour is 2, idle time is 500, which gives us 1,000. And as we say, all idle time variances are what here? They are adverse. Any other question? I hope I've answered this to the student's satisfaction. It's okay now. Thank you and thank you very much. So now we move straight away to the variable overhead cost variances. So we have here variable overhead. We have variable overhead cost variances. Variable overhead cost variances are two. We have variable overhead efficiency variance, which we shall be abbreviating as variable overhead efficiency variance like that. And then number two, we have variable overhead expenditure. Number two, we have variable overhead expenditure variance, which we shall be abbreviating as variable overhead expenditure variance. I would want to give you 1 minute. You try out doing the variable overhead efficiency variance. Oh, you told me that you had not taught you this. Let me teach you this variable overhead efficiency variance before I give you some time to look at some other variances. So variable overhead efficiency, so long as it's an efficiency variance, in brackets what do we have? Mr. Shah. In brackets here we have Mr. Who? Mr. Shah. In brackets we have Mr. Shah. In brackets we have Mr. Shah. And then outside here, because it's a variable overhead, outside here we'll have standard variable overhead. Parawa, because these are hours. Standard variable overhead. Parawa, like that. So now we are looking at variable overheads one at a time. We are looking at variable overheads one at a time, one at a time. So we have here variable overhead standard cost card, standard cost card. So go to that particular place where they are making reference to variable overheads. Please show them the question where they are making reference to variable overheads, where they are making reference to variable overheads. What do we have there? What do we have there? So where they are making reference to variable overheads, I'm able to see my variable overheads. I'm able to see my variable overheads. So variable overheads, 2 hours at 0.3. Variable overheads, we have 2 hours at $0.3 per hour. Giving us at the corner there 0.6. Then of course for variances, I know I'll be subtracting this vis-a-vis from what here from the actual. And the actual variable overheads, they have given us down there in the actual statement. In the actual statement, they have given us variable overheads. In the actual statement, we have variable overheads amounted to 2,600. 2,600. And then of course we have the actual hours. actual hours, use the ones of labor. Actual hours, use the ones of labor, and for that matter, it will be the actual hours that were worked. Actual hours that were worked, which were 8,000. Listen and listen to me very well, my great students. My great students, listen and listen to me very well. This capital SH, don't forget, it is standard hours for actual production. For actual production. These are the actual hours worked. So you write somewhere there in full, capital SH stands for standard hours for actual production. Standard hours for actual production. So the standard hours for actual production, if you look at your standard card, you can see the standard hours are how many here? They are 2. 2 times the number of units here that were actually produced, if you can remember, they were 4850. The actual number of units here that were actually produced, they were 4850. They were 4850 minus the actual hours. Actual hours, ladies and gentlemen, actual hours that we worked were 8,000. And I would want you to listen and listen to me very well. Consistently, we shall be making use of actual hours that were done what here that were worked. Actual hours that were worked. We only use actual hours paid in computations of the labor rate variance. Nowhere else. Nowhere else. Nowhere else. So we have here 2 times 4850 minus 8,000 multiplied by the standard variable overheads. The standard is here. Standard variable overheads per hour. Standard variable overheads per hour, they are supposed to be 0.3. They're supposed to be 0.3. 0.3. So please open brackets. We have 2 times 4850 minus 8,000, close brackets, times 0.3. Close brackets times 0.3. Please give me an answer.
Uh, 510F.
Thank you. Is it from one student only or from many students? From many students. Thank you and thank you very much. Thank you and thank you very much. 510 favorable. Could you kindly ask you a question? Ask me a question. Can you kindly ask me a question? Please ask questions. Ask questions. Remember, for online, there are a lot of factors in between. Some of you may not even be seeing me. Some of you may not be hearing what I'm saying. That's why I like knowing whether we're together.
Saying, John Cargo. We need a copy of the question we are looking at for reference, please.
Yeah.
Post it.
Very good. I'll be able to post it, but even yourself, John, you can screenshot. You see, like now the way you are seeing it there, you simply take a screenshot of your phone screen. The way you are seeing that question, if you take a photo of that, I know you guys are even younger, much younger than myself here. I know you know that technology. You simply take a photo of that. The moment you do that, you'll be left with something which you can even go ahead and print. So, Mr. John, have I taken care of your question, your worry? Have you done that? And I know you have been of help to many. You simply screenshot your phone. The moment you do that, automatically you have that question.
Robert is asking, what about fixed overheads volume variance?
Fine. We are not yet there. Remember, you are a cost accountant. You are a management accountant. In management accounting, how do you ascertain your costs? First of all, you start with materials. You go to wafanyikazi labor. From there, you go to variable overheads. After you finish variable overheads, now we'll go to fixed overheads. And then now for profitability, you do the sales. So, management accountant has to be quite schematic. You must scheme your work. First of all, materials. We have labor. we have variable overheads. And then now we go to fixed overheads. We are not yet there. Thank you very much for asking that question. Remember, every time you ask questions, you always get exposure. You always get exposure. And the good thing with me having practiced management accounting, I've been a management accountant of a serious firm for over 6 years before I transitioned to teaching. So I have the industry experience. And never be cheated by anybody. Management accounting is the real thing. Leave alone the financial accounting, debit credit. No. Management accounting, you are getting so much information from outside there. And then you compress everything, you do everything, you do analysis, you do your workings very well. For who? For the managers. So you'll be attending board meetings, unlike the other accountants. You'll be attending board meetings, advising, and most of the decisions of the company basically will be based on your own analysis, So if you are straight, if you're a great person in the terms of decision making, in terms of how you do your computations, your firm will always feel your effect more than any other accountant. If I were you, that's the line I would choose. Management accounting.
Another question. If asked to look for the variances, the examiner expects you to do all the variances you have done.
A very good student is asking, if you are told to compute variances, what does the examiner expect of you? Yes, to compute all variances. To compute all of them. And the question will be having so many marks, over 16 marks. I hope those formulas are not too many. I hope the formulas are not too many. Even if there are many, you don't have a choice. And if at my age I'm able to cram them, what about you? These are things that you can even come up with a song on them, and you master all of them. So here we are, ladies and gentlemen, variable overhead efficiency variance. Thank you very much. So you go to the next one called variable overhead expenditure variance. Variable overhead expenditure variance. So for variable overhead expenditure variance, what do we have here? For variable overhead expenditure variance, what do we have? Variable overhead expenditure variance, variable overhead expenditure variance. So variable overhead expenditure variance, I love this because this formula has got what? Some certain fruit that I really love. Variable overhead expenditure variance. How do we get it? We normally take standard variable overheads per hour multiplied by actual hours minus avocado minus avo, ile matunda ya kunonesha umbwa, unajua avo minus avo. So this is standard variable overheads multiplied by actual hours. Here for actual hours, what do you think? Am I going to make use of the actual hours that were worked or the actual hours that we paid? This AH, because every time I get AH, I have to ask myself, which AH? Is it the 8,500 or the 8,000? Actual hours paid or actual hours worked? Could you kindly advise me? What are most of my students they're saying? Not yet.
See, one saying paid, and I say worked.
Worked. All of them are saying worked, or paid.
Paid are many.
No, paid are many, and that's why they normally tell us that the road to hell is normally wider. Remember what we say, that labor rate variance, actual hours paid, are only used to compute labor rate variance. Nowhere else do we use them. Nowhere else. Actual hours paid are bad hours. We normally use them to calculate labor rate variance only. Otherwise, the effective hours that every farm will be happy about are the actual hours that were done what year? That were worked. So please come and give us the standard variable overheads per hour. The standard variable overheads here per hour are 0.3. Actual hours paid, or rather worked, to 8,000 minus AVO. AVO means actual variable overheads. Avocado. Avocado is a nice fruit. avocado. Siku hizi hazipatikani Kenya. Kenya tuna export avocado karibu zote, watuachia avocado zingine mbaya mbaya, watuachia avocado mbaya mbaya. So actual variable overheads, ladies and gentlemen, actual variable overheads, we have this dollars here. Go to the actual variable overheads. You will be able to see the dollars 2,600. Actual overheads here were 2,600. Please give us a figure. Actual variable overheads, you'll be able to see 2,600. 2,600. So for the actual variable overheads, ladies and gentlemen, you'll be able to see 2,600. So could you kindly give us this difference? Somebody, what do we have here? What do we have here? What do we have here? So 0.3 times 800 minus 2,600. What do we have, somebody? They are not talking to me. They are not talking to me. What is the answer, somebody?
200 adverse.
200, I'm being told negative, which is adverse. And remember, I don't know, for whatever reason, you'll get some students putting brackets where they're not supposed to be put. No. For variable overhead expenditure variance, there are no brackets at all. For variable overhead expenditure variance, there are no brackets at all. No brackets at all. Thank you, and thank you very much. Now, from there, ladies and gentlemen, let's go straight away to the fixed overheads. So fixed overheads. So we go to the fixed overheads. So fixed overhead cost variance. Fixed overhead cost variance, what do we have there? We have two things. We have the fixed overhead volume variance. We have the fixed overhead volume variance, and then number two, we have the fixed overhead expenditure variance, fixed overhead volume variance, and then number two, fixed overhead. I have to give somebody 200 shillings this morning. I want to give somebody 200 shillings this morning. I would want to give that money to any student who will be the first student to get the two variances correctly. So speed is of essence. Speed is of essence. The moment you get your answer, two answers, write the two answers there, and besides those two answers, write your mobile phone number. I sent to you 200 shillings. I sent you 200 shillings right now. Tell us who was that first student who got this correct. For this one, we are sending 100. We are set for us to be fair, because it's possible to get someone who gets this correct and then he doesn't get the other one. So for this one, what do we have here as the fixed overhead volume variance, somebody? Out. What do we have here? Someone help me out. What do we have here? Open brackets, this minus this, close, times 7.4. Please give us a figure. 1850 adverse. Is there somebody who got 1850 adverse among the ones who gave us that answer? The first one to get 1850 adverse. Yvonne. So Yvonne, you have my 100 bob this morning. Please give me your number there. I'll be able to send you.
But she said favorable.
Oh, favorable.
But it's okay.
No, it can't be okay if it's favorable. That is wrong. Why? Because fixed overhead volume variance is an exceptional variance. If you can remember the exceptional variances, we have number one, fixed overhead volume. Number two, we have fixed overhead capacity variance. And then number three, we have all sales variances. All sales Variance says are exceptional. Being exceptional doesn't make them to be very hard to compute. To be hard to compute. No. Exceptional means that whenever we get them as positive, like this positive, we interpret them in the opposite way. Ordinarily, this having been positive, I would have said favorable. But when I have a keen look at the variance which you are computing, it's fixed overhead volume. So I'll have to give it a negative interpretation, an opposite interpretation. So 1850 adverse.
So you take Jocelyn because
No, I think Jocelyn has just gotten it now after planning. She got it earlier.
Yeah.
Is that the position of all the other students? What are the other students saying about who was the first one to get this 1850? Before I did the question, who was the very first to get this 1850 advance?
It was Jocelyn.
Let me get it from other students. Because from what I can see, my admin here, my admin wants me to lose my money today this morning. What are the other students saying?
Jocelyn herself saying nobody, but Jutago is saying Jocelyn.
Okay. Okay.
Phyllis is saying Yvonne should get it.
No, Yvonne got it or 1850, but she said favorable, so she can't get the money. We want precision, like what we call military precision.
Saying Jocelyn.
Jocelyn, then Jocelyn. Now Jocelyn should be able to give us her number. Thank you very much. Now the other student who should be able to get 100 bob is a student who got this fixed overhead expenditure variance. Let's see whether there is any. We'll be able to get this correctly. To get fixed overhead expenditure variance, we normally take budgeted fixed overheads minus actual fixed overheads. So we have here budgeted fixed overheads minus actual fixed overheads. That is the formula. Please write this formula in full. BFO is budgeted fixed overheads minus actual fixed overheads. So please go to your budget. My budget, I'm budgeting to produce 5,100 units. And in terms of the standard costing, I know that each unit is 7.4. So to get the total budgeted fixed overheads, I'll take 5,000 times 7.4 minus the actual fixed overheads. Actual fixed overheads are 42,300. So will you kindly give me this answer? Can you give me this answer? And we are almost coming to the end of the lesson. I'm only left with two variants. Like I'll have to finish today kindly. Kindly today I'll have to finish. Today I must finish kindly. Today I must finish. So what variance are we getting? Somebody here?
4560F.
4560 favorable. Is there anyone who got this figure? No, first of all, let's see whether this figure is correct. Remember, fixed overhead expenditure variance is not among the exceptional. So interpret it normally. Interpret it normally. Interpret it normally. So 4560 favorable. So is there any student who got this correctly? Because I want to send the money now. Nobody. So there is Jocelyn who gets 100 bob at the moment. So Jocelyn, please give us your number. We send you the money right away. Some of these presents can't wait.
Let me see. Yvonne got it.
Yvonne got 4560 favorable.
She got advance.
Let's see. Perhaps we are the ones who are wrong. Let me get my calculator.
Most of them are saying favorable, but the last one saying it's adverse.
The last one says it's adverse.
The last one, yeah.
So we have here 500 times 7.4 minus 42,300, which gives us, no, it's 500 and 5,100, sorry. 5,100 times 7.4 minus 42,300, which will end up giving us minus 4560. So minus 4560 is supposed to be adverse. Minus 4560, this is supposed to be adverse. I think there is something that is still confusing you people. Minus 4560 is supposed to be 4560 what here? Adverse. If it's a negative, it's adverse. If it's a negative, it's adverse. Not unless it happens to be coming from among these three things. These three things. So remember, we are saying that if positive, favorable, favorable. If positive, favorable. If negative, adverse. If negative, adverse. Except what here, somebody? Except these three. Those three, normally, we interpret them in the opposite way. We normally interpret them in the opposite way. So 4560, adverse. So then Yvonne is correct, isn't it? Thank you very much. So then can I kindly have the numbers of Jocelyn and Yvonne there right away? I sent them there 100 more. 100, very fast. For Jocelyn, let me go to my M-Pesa. Whenever we are computing variances and we happen to get positive variance, all of them are what here favorable. Negative variances are also what here? Negative variances are adverse. So this should always be the pattern, except these three variances that we are calling exceptional: fixed overhead volume, fixed overhead capacity, and then we have sales what here? Sales variances. So for fixed overhead volume, if positive, take it to be adverse. All the three actually. If they are positive, instead of them impacting on our profits here positively, they will be disadvantaging us. Is that okay? Now, please allow me to go to our last type of variances called the sales variances. So we have here sales variances. So right there, sales variances. So sales variances are two. We have material price variance, what we shall be abbreviating as MPV. And then number two, we have the material usage variance. So we have material price variance and the material usage variance. So we start with the first one, which is the material price variance. So how do we get material price, or not material, sorry, sales? I'm going back. This is supposed to be sales. So we have in this case here, sales price variance. So we have the sales price variance, sales price variance. And then number two, we have the sales volume variance, sales volume variance, I went back to the price, material price. So sales volume variance, and then we have sales price variance. So this is supposed to be SPV. This is SVB. So to get the sales price variance, ladies and gentlemen, sales price variance, what do we have here, somebody? We have the standard selling price. The standard selling price minus the actual selling price. Selling price multiplied by actual quantity that was done what here? Sold. So please go to the standard card, the standard cost card. You'll be able to see the standard selling price. And then the actual information, you'll be able to see the actual quantity sold. Actual quantity sold, like that. Actual quantity sold, like that. Okay, so in my information that I have here, in that question that has been pinned on your screen, the question that has been pinned on your screen, ladies and gentlemen, on that question that has been pinned on your screen there, what do you have? On that question pinned on the screen, Ladies and gentlemen, this is what we have. This is what we have. The standard selling price is 20. The standard selling price is 20. And then we have the actual quantity sold. You can see from the actual information, the actual production was 4850 units. And we are told that the total sales revenue equals 9,800, 95,600 dollars. Now, out of this, I'll be able to get my parameters very well. I will start with the standard selling price. The standard selling price is 20 minus the actual selling price. The actual selling price, I can see this 4850 units gave me this money. How about the money I was given by 1 unit? It will be 95,600 divided by 4850. Multiply this by the actual quantity, which was sold again, which is this 4850. So will you kindly give me an answer here? Kindly give me an answer there. Kindly give me an answer there. Kindly give me an answer there. So you have 20 minus 95,600 divided by 4850 times 4850. What figures do we have? Somebody here?
1400 adverse.
1400 adverse. Thank you, and thank you very much. The question is it adverse or favorable? Adverse. Adverse. Let me see whether they are correct. Let me see whether they are correct, and then I'll be able to give some present to some few people here. If they are correct, I'm giving them presents right away. 95, 600. Yote kwa corona, kipata shilingi 100 ni mzuri sana. So I'm getting 19. Yes. So it's supposed to be a positive answer, but my students have been able to know that it's supposed to be adverse because all sales variances are exceptional. 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 So from there, come and give me the sales volume. The sales volume variance. Come and give me the sales volume variance. So how do I get sales volume variance? To get the sales volume variance, ladies and gentlemen, we normally take budgeted volume minus actual volume. And then outside here, we normally put the standard profit per watt year per unit. So to get sales volume variance, we normally take the budgeted volume minus the actual volume. This is a funny one because outside here we have the standard profit per watt year per unit. So we have budgeted volume minus actual volume times standard profit per unit. So come and give us the budgeted volume, the volume of production, the volume which we're planning to produce was 5,100 minus the actual volume, which is 4850. From the standard card, is there somebody who is able to see from the standard card? Please pin the question for them. Pin the question for them. Are they able to see the standard profit per unit? Is there anybody who is able to see the standard profit per unit? Someone talk to me. By talking to me like this, you could very easily get a present. So standard profit per unit, what we have there, somebody. They're not talking to me. How many are they, by the way?
There are 44.
Okay. So standard profit per unit, what do we have here, somebody? 6. Thank you very much. So could you kindly give me this answer here? 5,100 minus 4850 times 6 times 6. Give me an answer, somebody.
1,500.
1,500, adverse or favorable?
Adverse.
Adverse. 1,500 adverse. And now that marks the end of all our variances. The only thing that we need to do for us to go and relax, is to come, ladies and gentlemen, here, and ascertain, is to come, ladies and gentlemen, here, and do a reconciliation. So please, my friend, a reconciliation statement, also known as what here? An operating statement. Also known as an operating statement, where we shall come and start with budgeted profit. Budgeted profit, you're the ones who have given me a figure of 6. And I know how many units I'm supposed to be talking about, 5,100. So 6 times 5,100, could you kindly give us an answer? 6 times 5,100, what do we have here, somebody? I want to know the total profit that I was budgeting to receive. So we have here 6 times 5,100, which will end up giving us what figure, somebody here?
30,600.
30,600. And then in between here, we have variances. All those variances of ours, we name them. We have the material price variance, material usage variance. We have labor rate variance, labor efficiency variance. We have the idle. We have the variable overhead efficiency. We have variable overhead expenditure. We have fixed overhead expenditure. We have fixed overhead volume. We have sales price variance. We have sales volume variance. Write all of them down. 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 Somebody, I would want you to write in the statements there, like MPV, you give us the figure that we got. In the statement there, MPV, give us the figure that we got. First of all, copy them down, and then you start writing for me in the comment section. And then I'll be able to advise you. MPV equals Please give us the figures very fast. We finish in 2 minutes.
600A.
600A. How about MUV?
500F.
500F. Thank you very much. How about labor rate variance? LRV. 200F. How about LEV? Labor efficiency variance. What do we have there? Labor efficiency variance.
3,400F.
3,400F. How about idle time? I know it's 1,000 at rest. 1,000 at rest. How about variable overhead efficiency?
510F.
510F. Are you sure? Variable, please again look at this keenly. Variable overheads efficiency variance. Is it 510 favorable? Someone to confirm for us. Is it 510 favorable really? Yes. How about variable overhead expenditure? Variable overhead expenditure. What do we have here? Somebody, variable overhead expenditure variance. 200 adverse. Thank you very much. So fixed overhead expenditure.
4560 adverse.
4560 adverse. Thank you. Volume.
1850 adverse.
1850 adverse. Sales price.
1400 adverse.
Sales volume. 1500 adverse.
100 adverse.
Thank you very much. So please we have our actual profit. We have our actual profit. Our actual profit, we'll talk of 3,600 minus this, because it's advanced. 3,600 minus 600 plus 500 plus, because they are favorable, plus, minus, plus, in your calculator, minus, 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 minus. And then you'll be able to give us our actual profit down here. So 3,600 minus this, plus this, plus this, plus that, minus, plus, minus, 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 minus. Give us a figure. So is there anybody who is able to give us a figure here very fast? Please give us a figure. Someone who is able to give us a figure here very fast. What do we have here? Somebody.
$24,100.
24,100. 24,100. And now that marks the end of our question, ladies and gentlemen. The thing that I would want you to do, although in an exam situation you don't do it, you can come and prove for these people, you can come and prove if you wish, but in an exam never do that. Please pin for them the question there. When you pin for them the question there, what are you going to see there straight away? If you pin for them the question there, if we pin for them the question, in the actual section, actual information section, you are able to see the actual sales revenue. As you are seeing them, you will be writing them on your book there. The actual sales revenue. I'm able to see 95,600. 95,600. And then I have material costs. As an accountant, I can see material cost there. Material cost there is 9,800. Material cost is 9,800. And then I can see labor cost. Labor cost, I can see labor cost of 16,800. That's labor cost. After that, we have variable overheads. I can see 2,600. And then I have fixed overheads. What do I have? Fixed overheads down there. Fixed overheads, ladies and gentlemen, down there. We have 42,300. 42,300. So please come and subtract these ones from the revenue for you to be able to get, if you could show them my board now, for you to be able to get the actual profit from the actual information. You can just prove, although this one you're saying that it is very much what you unnecessary. It is very much unnecessary. So we want to see whether you guys are going to get the same figure of 24,100. Let me see whether we shall be getting that figure of 24,100 at the end of the day.
Yes.
Is there somebody who is able to see 24,100?
Yeah.
24,100. So now that marks, of course, the end of our class today. What I don't know, especially from the summit students, how comes many students are not attending?